the most useful type of capital asset in the world to everyone under all circumstances at all times. That's Bitcoin. So if I were to say it ought to be twice as performant as the next best thing, that wouldn't be unreasonable. My forecast is it's probably 50% better, maybe 60, 70% better than the next best thing. So my long-term forecast is like 21% ARR and 21 vol. And I would say, the S&P will be more like 10% ARR, 15 vol. Bitcoin's going to have the higher Sharpe ratio. Bitcoin's going to have the higher vol. Bitcoin's going to have the higher performance because it's engineered and it's accessible.
Bitcoin continues to attract prominent voices, and few are louder than Michael Saylor. The former MicroStrategy CEO has staked his reputation on the idea that Bitcoin isn't just another asset, it's the best performing capital allocation strategy of our time. His argument rests on a simple comparison: Bitcoin versus the S&P 500. Historically, the S&P has delivered around 10% annual returns over the past century. That's the benchmark most investors consider high-quality equity capital. But Saylor argues Bitcoin will leave that in the dust, projecting long-term returns in the 18 to 21% range. Why the confidence? He points to structure. The S&P 500 is slower, less liquid, and ultimately shaped by human rules, corporate governance, and decision-making. Bitcoin, on the other hand, is open, programmable, and governed by code. It's volatile, yes, but Saylor sees that volatility as the price of efficiency. To him, Bitcoin isn't competing with stocks. It's redefining what capital allocation looks like in the digital era. I still think the vast majority of the capital flowing into the space is flowing into Bitcoin, he told Bloomberg in August. He highlighted the surge in corporate adoption, from about 60 companies capitalizing on Bitcoin 6 months ago to 160 today. That kind of momentum, he says, is why he remains laser-focused on Bitcoin above all else. MicroStrategy seems ready to double down again. With Bitcoin trading just under its all-time high of $124,000, Saylor signaled the company is preparing another purchase. For him, every pullback or consolidation is just another entry point into what he views as the ultimate long-term store of value. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Yeah, well, you can look at the history, right? Bitcoin's been decelerating from 120% a year growth to 100% growth to 80%. It was clocking at 80, 90% when I got into it. It's been about 55 to 60% for the past 5 years. If you look at the rate, my forecast is it decelerates from 55% ARR down to 20% ARR over 20 years. Why is it decelerating? Well, obviously, for the law of large numbers, when you've got a $100 trillion asset, you're not going to grow 80% at that level. It's decelerating because it's merging with the capital markets, and as it merges with the capital markets, then there's less and less money. It's harder. Anybody knows $1 million company can grow faster than $1 billion company, which can grow faster than a $10 billion company, which can grow faster than a $100 billion company, which can grow faster than a $1 trillion company, which can go faster than a $10 trillion company, which can grow faster than a $100 trillion company, right? Not complicated. It's simply the law of large numbers and math. The 20% target is, if I look at it, if you want a bucket of the most high quality scarce capital in the world before Bitcoin was the S&P index. It's basically equity capital that's managed, via buybacks in order to stay reasonably scarce. And you know what that benchmark is. It's been about 10% a year for 100 years. Right? So what are you going to get from the S&P? 10 to 12%, 10, 13, the actual amount's going to be a function of the growth and in the equity plus the expansion in the money supply. I think that Bitcoin will outperform the S&P index. And I think it's very simple as to why it will outperform the S&P index. It doesn't have the counterparty risk of corporate structures. And it doesn't have currency exposure, right? So the S&P is saddled with a huge amount of corporate risk factors, dozens and dozens of them, tariff, supply chain, etc. It's got legal risk, it's got political risk, it's got physical risk. I have warehouses, I have nexus, I have an operation in Ukraine, I have, natural gas facilities in Iran. right? There are a lot of things in the real world that constitute risks in the S&P. If I strip away the physical risk, and if I strip away the political risk, and if I strip away the management risk, and then every company takes in cash flows and pesos and naira and euros and CNY and rubles and dollars and Canadian currency and AUD and whatever. So when you strip away all of those risk factors and keep the pure capital, you've got Bitcoin. So whatever those things are, Bitcoin will be more than that. How much more? Or like what is the cost of that? 6 to 8% a year. So if you're targeting the S&P at 12, you target Bitcoin at 18 to 20. Why will it be 18 to 20? I stripped away the risk factors. I also stripped away the constraints. For example, you cannot go long 50x on Apple stock on Sunday morning in Iran, right? You can't. We could talk about why you can't, but you just can't. So you can't go long and you cannot short an equity 20x on Sunday morning. So you have all of these guardrails on equity, and they limit the leverage, they limit the utility. If I had pure capital and I could have unlimited leverage, unlimited utility anywhere in the world, 24/7, 365, there are no holidays for Bitcoin, right? So what happens on a bank holiday to a security that you should short or you should go long? Well, you can't. Okay, so that bucket, that benchmark, which is the S&P, it's less volatile, it is less liquid, it is less useful, it is more risky, it is more diversified, and it's got some human factors in it too. I mean, the S&P board just decides what to put in it, right? Like maybe they don't put the right thing in. Maybe they leave something that shouldn't be in it, right? So if you're looking for a pure, objective monetary index governed by the laws of nature, the most useful type of capital asset in the world to everyone under all circumstances at all times, that's Bitcoin. So, if I were to say it ought to be twice as performant as the next best thing, that wouldn't be unreasonable. My forecast is it's probably 50% better, maybe 60, 70% better than the next best thing. So my long-term forecast is like 21% ARR and 21 vol. And I would say, the S&P will be more like 10% ARR, 15 vol. Bitcoin's going to have the higher Sharpe ratio. Bitcoin's going to have the higher vol. Bitcoin's going to have the higher performance, because it's engineered and it's accessible.
Michael Saylor doesn't waste time worrying about short sellers circling Bitcoin-focused companies. In his view, if a Bitcoin treasury is run correctly, shorts don't stand a chance. He breaks it down with an example. Imagine a company holding $1 billion worth of Bitcoin, but the market values its equity at only $900 million. The smart play? Issue $100 million in Bitcoin-backed investment-grade credit, use that capital to buy back shares, and erase the discount. That's why Saylor dismisses the idea that shorts can meaningfully hurt well-managed Bitcoin firms. Nobody's going to short $10 billion and hold it to infinity, he says. Most short sellers dabble, probing for weakness, but when the pressure builds, they exit. On the other side of the trade, Bitcoin maximalists stand with deep conviction, patient timelines, and strong balance sheets. That's why, in his view, they consistently win. Saylor's conviction shows in how he approaches Bitcoin's volatility. When the market plummeted from $66,000 to under $20,000, many traders abandoned ships. Saylor didn't. He was just as confident buying at $19,000 as he was at the highest. To him, that drop wasn't proof of Bitcoin's failure but a chance to accumulate at less risky levels. Where short sellers see momentum shifts and sentiment swings, conviction investors see fundamentals that don't change with price. Let's get back to the interview.
It's a global monetary index, or you could say it's the greatest global investment index in the world. If you want to characterize as global productivity index, you could do it. If the world's more productive, that will flow into Bitcoin.
Mm-hmm.
If the world inflates the currency supply, it'll flow into Bitcoin. If the world is more insecure, that should flow into Bitcoin, right? So it's being driven by chaos. It's being driven by order. It's being driven by conflict. It's being driven by the robots, right?
Yeah.
eventually, if the robots do all the work and there's 1 trillion AIs in cyberspace doing the thinking and the cars drive themselves and 1 billion robots build all the robots and produce everything, there's going to be massive amount of equity value created for the companies that own the robots to build the robots. All that money is going to flow into Bitcoin. If you have a well-run Bitcoin treasury company, say you have $1 billion of Bitcoin and your equity trades to $900 million in equity value, what do? The logical thing you do is you issue $100 million of BTC 10 rated credit, investment grade credit like Strife, buy the stock back, right? Then, issue $200, $300, $400 million worth of junk credit like Stride and buy the stock back. So you issue preferreds and then you buy the stock, or you issue something like Strike, issue a convertible preferred with a 200% premium built into it and buy the equity back, right? The equity investors will look at that and they'll think, well, there's massive volatility, massive leverage. Why wouldn't I want to buy that? It's like I'm buying the senior 20% of the capital structure and I'm creating a short squeeze. So the real key to protecting the equity premium in a Bitcoin treasury company is building these BTC-backed credit instruments and getting them floating in the preferred market and attaching an ATM to them. If you have, the reason to do what I've described is offensive, because if you have a good BTC credit program, the MNAV could trade to 3, 4, 5, 6, 10. Right? I mean, you could trade at a massive multiple. Like, by the way, I'm just describing price to book. If you look at how you value a bank, they're like, oh, that trades at 2 times book value. Well, MNAV of 2 is 2 times book value for the company, right? So if you have the credit instruments, you create leverage, the equity will trade up. So it's offensive, but it's also defensive. If the shorts jump on you, how do you rip the faces off of the shorts? You sell the credit instruments, and like, what would you hope? You would hope that they would short you to 50%, of net asset value. You would sell 200 million worth of a junior preferred or a senior preferred, buy the stock back, and you're monetizing the discount. You're actually generating BTC yield buying the stock. And then you create a short squeeze. And as soon as you start to squeeze the shorts on that side, all the equity investors will jump on it, and the options investors will jump on it, and they'll rip their faces off. So you don't really have to be in fear if you're a financial engineer. You have $100 billion of Bitcoin. You're either trading at a premium and you're selling the equity, or you're trading at a discount and you're selling the credit, right? What shuts that down? If you can't sell the credit, right? If you've impaired, the reason that the company struggles is you've impaired the capital structure somehow by doing something stupid. But if you have unimpaired capital structure, if I have $100 billion of Bitcoin, I should in theory be able to sell 10, 20, 30, 40, $50 billion of credit at various rates, BTC 10, 5, 3, 2. When you do that, you either buy Bitcoin or you buy your own equity back, but you wouldn't have to buy that much equity back before. Like once you punch a bully in the face, like if the short seller gets to a certain level, once you slug them in the face, right, that they're not really in it for the pain. As far as I could see, there's really no intelligent investor who's a short seller. Like, for example, they don't have any courage. There's no one with $10 billion of capital saying, I'm willing to go short $10 billion and lose it all. Right? So, you got a fund, the guy dabbles in it. He's like, I got a short, but no one wants to ride that one to infinity. They just don't have the courage, right? So they'll skirmish with you for a bit, but at the end of the day, the winners in this market are people that have conviction and capital, and they're willing to look out a decade. And that's the advantage of the Bitcoin maximalist, right? Like we can go harder than anybody else. We can outlast anybody else. If you look at my best speech, by the way, I think my best speech is at the Atlas Society if you go and you pull it. And if you look at me, I'm quite confident and comfortable and articulate, and I didn't have any concerns whatsoever. I think Bitcoin that night had crashed from 66,000 down to 19,000, and it was trading below 20,000. And I had friends in the audience said, yeah, you were so persuasive. I went and I bought Bitcoin that day. I felt like I didn't have enough. Well, we were buying it at 19,000, 18, 17, and 16,000. I was just as convicted then as I am now. I didn't feel any different. The shorts, they can't handle that, right? Their brains don't work that way, right? I mean, they're not acting from fundamentals or first principles. My view is just, well, it's pretty obvious Bitcoin's oversold due to the crypto leverage coming out of the system. That makes it less risky and a better buy today than it was at 50,000. Why wouldn't you buy more?
What's unfolding in the digital asset landscape looks less like speculation and more like the maturing of a new financial architecture. Traditional equities still command enormous influence, but the weight of corporate governance, economic cycles, and human decision-making constrains their returns. Digital money, by contrast, operates on rules that don't bend to quarterly earnings or political pressure. That's why its volatility, often seen as a flaw, is increasingly being interpreted as a sign of dynamic efficiency. Companies adopting it are not merely hedging, they're restructuring their balance sheets for a future where code, not committees, determine stability. The persistence of buying through downturns and the rejection of short-term sentiment reveal a more profound conviction. This asset isn't being treated as a trade, but as foundational capital for the decades ahead. The trend toward corporate accumulation suggests that what was once fringe is becoming institutional bedrock. Could the accelerating integration of digital money into corporate balance sheets eventually challenge equities as the primary benchmark for long-term capital growth? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.